Hello friends, good morning, good afternoon, good evening, whenever you're watching or listening to my channel NSR Audiobooks. Welcome back to my channel. Let's roll up to next topic. Investing psychology delves into various concepts that influence investors' decision-making processes and behaviors. Here are a few key concepts explained from a psychological perspective. Loss aversion. This concept, popularized by Daniel Kahneman and Amos Tversky, suggests that people feel the pain of losses more strongly than the pleasure of gains. In investing, this can lead investors to hold on to losing investments for too long, hoping they'll rebound, instead of cutting their losses. Confirmation bias. This bias refers to the tendency to seek out information that confirms our existing beliefs or decisions while ignoring or downplaying contradictory information. In investing, this can lead investors to only pay attention to news or analysis that supports their investment thesis, potentially missing critical information that could alter their decisions. Overconfidence. This bias involves having an inflated belief in one's own abilities, knowledge, or judgment. In investing, overconfidence can lead investors to take excessive risks or trade too frequently, believing they can outperform the market consistently. Herd mentality. This concept describes the tendency of individuals to follow the actions or beliefs of a larger group, often without critically evaluating those actions or beliefs. In investing, herd mentality can lead to market bubbles or crashes as investors collectively rush to buy or sell assets based on the actions of others rather than on fundamental analysis. Anchoring. Anchoring refers to the tendency to rely too heavily on the first piece of information encountered, the anchor, when making decisions. In investing, this can manifest as investors placing too much importance on the price at which they initially purchased an asset, leading them to hold on to it even when new information suggests they should reconsider. Framing effect. This effect relates to how the presentation or framing of information can influence decision-making. For example, presenting investment returns as either gains or losses can lead investors to perceive the same information differently based on how it's framed, even though the underlying data is the same. Regret aversion. This bias involves making decisions to avoid feelings of regret, even if those decisions may not be the most rational or beneficial in the long term. In investing, regret aversion can lead investors to avoid selling losing investments, because they fear regretting the decision if the investment eventually turns profitable. Loss aversion is a concept deeply explored in The Psychology of Money by Morgan Housel. The book delves into how humans perceive and react to financial gains and losses. Here's an explanation of loss aversion from the book's perspective. Loss aversion, as described by Housel, refers to the human tendency to strongly prefer avoiding losses over acquiring gains of the same magnitude. In other words, the pain of losing money is psychologically more significant than the pleasure of gaining the same amount of money. Housel illustrates this concept by highlighting that individuals often make financial decisions based on the fear of losing money rather than the potential for gains. This can lead to conservative investment strategies or reluctance to take risks, as people prioritize protecting what they have over pursuing potential growth opportunities. The book emphasizes that understanding loss aversion is crucial for investors because it can influence their behavior in the financial markets. Investors who are overly focused on avoiding losses may miss out on profitable opportunities or make decisions based on short-term emotions rather than long-term financial goals. Housel's exploration of loss aversion in The Psychology of Money underscores the importance of balancing risk and reward in investment decisions, acknowledging the emotional aspects that can impact financial choices, and adopting strategies that align with one's risk tolerance and objectives. In The Psychology of Money by Morgan Housel, confirmation bias is discussed in the context of how it affects our financial decision-making processes. Here's an explanation of confirmation bias from the book's perspective. Confirmation bias is a cognitive bias that leads individuals to seek out, interpret, and remember information in a way that confirms their pre-existing beliefs or hypotheses. In the realm of finance and investing, confirmation bias can have significant implications for decision-making. Housel explains that people often have deeply ingrained beliefs about money, investing, and the economy based on their upbringing, experiences, and exposure to information. When faced with new information or opinions, individuals tend to give more weight to those that align with their existing beliefs while discounting or ignoring contradictory information. This bias can lead investors to selectively seek out news, analysis, or experts that support their investment decisions or market views, even if they are not objectively accurate or reliable. For example, an investor who believes that a particular stock will perform well may focus on news articles or analysts' reports that validate this belief, while disregarding negative information or alternative perspectives. Confirmation bias can also contribute to the formation of investment bubbles or market trends, as individuals collectively reinforce each other's beliefs and actions, leading to a self-reinforcing cycle of confirmation. In The Psychology of Money, Housel highlights the importance of being aware of confirmation bias and actively working to counteract its effects. This includes seeking out diverse perspectives, challenging one's own assumptions, and being open to new information that may challenge existing beliefs. By doing so, investors can make more informed and rational decisions that are less influenced by cognitive biases, like confirmation bias. In The Psychology of Money by Morgan Housel, overconfidence is explored as a cognitive bias that can significantly impact financial decision-making. Here's an explanation of overconfidence from the book's perspective. Overconfidence refers to an individual's tendency to have excessive confidence in their own knowledge, abilities, or judgments. In the context of finance and investing, overconfidence can manifest in several ways that may lead to suboptimal outcomes. Illusion of control. Overconfident individuals may believe they have more control over outcomes than they actually do. This can lead them to take excessive risks or engage in market timing strategies based on their belief that they can accurately predict market movements. Excessive trading. Overconfident investors may trade more frequently than necessary, believing they have superior insights or skills that enable them to outperform the market. This can result in higher transaction costs, taxes, and a higher likelihood of underperformance compared to a buy-and-hold strategy. Failure to diversify. Overconfident investors may concentrate their portfolios in a few investments or asset classes, believing they have identified the winners that will outperform others. This lack of diversification increases their exposure to idiosyncratic risks and can lead to significant losses if their chosen investments underperform. Disregard for risk. Overconfidence can lead investors to underestimate the risks associated with their investments. They may believe they are more skilled at managing risk or that they can withstand larger losses than is realistic, leading to a mismatch between their risk tolerance and the actual risk exposure in their portfolio. Housel's exploration of overconfidence in The Psychology of Money underscores the importance of humility, self-awareness, and a realistic assessment of one's abilities in financial decision-making. By acknowledging the limitations of their knowledge and expertise, investors can avoid the pitfalls associated with overconfidence and make more prudent and balanced investment decisions. In The Psychology of Money by Morgan Housel, herd mentality is discussed as a behavioral bias that influences financial decision-making. Here's an explanation of herd mentality from the book's perspective. Herd mentality, also known as herd behavior or groupthink, refers to the tendency of individuals to follow the actions, beliefs, or behaviors of a larger group without critically evaluating them. This phenomenon is prevalent in various aspects of life, including finance and investing. In the context of investing, herd mentality can lead to significant market movements, bubbles, and crashes. Housel explains that investors often look to the actions of others as a signal for how they should behave, especially in uncertain or volatile market conditions. Key aspects of herd mentality in finance include fear of missing out. FOMO investors may join the herd out of fear of missing out on potential gains. When they see others profiting from a particular investment or asset class, they may feel compelled to follow suit without conducting thorough research or analysis. Social proof. Herd behavior is reinforced by social proof, which is the tendency to assume that the actions of others reflect correct behavior. When investors see a large number of people buying or selling a specific asset, they may interpret this as a signal that they should do the same, regardless of the underlying fundamentals. Lack of independent thinking. Herd mentality can lead to a lack of independent thinking and critical analysis. Instead of forming their own investment thesis based on research and due diligence, investors may simply mimic the actions of the crowd, leading to irrational market movements. Exacerbation of market extremes. Herd behavior can amplify market extremes, leading to bubbles or crashes. During bull markets, investors may collectively drive prices to unsustainable levels due to the herd's buying frenzy. Conversely, during bear markets, panic selling driven by herd behavior can lead to sharp declines in asset prices. Housel's exploration of herd mentality in The Psychology of Money underscores the importance of independent thinking, rational analysis, and a long-term perspective in investment decision-making. By resisting the urge to blindly follow the herd and instead focusing on fundamental principles, investors can avoid the pitfalls associated with herd behavior and build more resilient portfolios. In The Psychology of Money by Morgan Housel, anchoring is discussed as a cognitive bias that influences financial decision-making. Here's an explanation of anchoring from the book's perspective. Anchoring refers to the human tendency to rely too heavily on the first piece of information encountered, the anchor, when making decisions. Once an anchor is set, subsequent judgments or decisions are often made in relation to that initial reference point, even if it's irrelevant or arbitrary. In the context of finance and investing, anchoring can have significant implications for how investors perceive and evaluate information. Price anchoring. One common example of anchoring in investing is price anchoring. Investors may anchor their perception of a stock's value based on its historical price or the price at which they initially purchased it. This can lead to biases in decision-making, such as holding on to a stock despite new information suggesting it's overvalued or undervalued. Market expectations. Anchoring can also influence investors' expectations about market performance. For example, if investors become anchored to a period of strong market returns, they may develop unrealistic expectations about future returns and take on excessive risk to chase those returns. Comparative anchoring. Another form of anchoring involves comparing investment options based on arbitrary reference points. For instance, an investor may anchor their perception of a stock's attractiveness to its price relative to a previous high, rather than considering its fundamental value or growth prospects. Psychological impact. Anchoring can have a psychological impact on investors, leading them to place undue importance on certain information or factors while neglecting others. This can result in suboptimal decision-making and missed opportunities. Housel's exploration of anchoring in The Psychology of Money emphasizes the importance of being aware of this bias and actively working to mitigate its effects. By consciously seeking out diverse perspectives, challenging preconceived notions, and basing decisions on objective analysis rather than arbitrary anchors, investors can make more informed and rational choices in their financial endeavors. In The Psychology of Money by Morgan Housel, the framing effect is discussed as a cognitive bias that influences financial decision-making. Here's an explanation of the framing effect from the book's perspective. The framing effect refers to the way in which information is presented or framed can significantly influence decision-making. This bias highlights that people often react differently to the same information depending on how it is framed, even if the underlying facts remain unchanged. In the context of finance and investing, the framing effect can manifest in several ways. Gain-loss framing. One common aspect of the framing effect is gain-loss framing. When presented with an investment opportunity, investors may react differently based on whether the potential outcome is framed as a gain or a loss. For example, investors may be more risk-averse when presented with a potential loss compared to a potential gain of the same magnitude. Positive versus negative framing. The framing effect also applies to how investment options or financial products are described. Positive framing emphasizes potential benefits, while negative framing highlights potential risks or drawbacks. Investors may be more inclined to favor options that are positively framed, even if the underlying risks are significant. Contextual framing. The context in which information is presented can also influence decision-making. For instance, investors may perceive a stock as attractive if it is framed as undervalued in a market downturn, even if the fundamentals suggest otherwise. Emotional impact. The framing effect can evoke different emotions based on how information is framed. Positive framing may elicit feelings of optimism and excitement, while negative framing may induce fear or caution. Housel's exploration of the framing effect in The Psychology of Money underscores the importance of being mindful of how information is presented and how it can impact financial decisions. By recognizing the influence of framing and considering information from multiple perspectives, investors can make more informed and objective decisions that align with their financial goals and risk tolerance. Regret aversion, as discussed in The Psychology of Money by Morgan Housel, is a psychological bias that influences financial decision-making. Here's an explanation of regret aversion from the book's perspective. Regret aversion refers to the tendency of individuals to avoid making decisions that they fear will lead to feelings of regret in the future, even if those decisions may be rational or beneficial in the long run. This bias is driven by the desire to minimize or avoid negative emotions associated with making a wrong choice, i.e. in the context of finance and investing. Regret aversion can manifest in several ways. Avoidance of losses. Regret-averse investors may be hesitant to sell losing investments, even when it's financially prudent to do so. They may hold on to these investments in the hope that they will recover, fearing the regret of realizing a loss if they sell. Inaction bias. Regret aversion can also lead to inaction or procrastination when it comes to making investment decisions. Investors may delay making necessary changes to their portfolios or implementing new strategies out of fear that they will regret their choices if the outcomes are not as expected. Herding behavior. Regret aversion can contribute to herd behavior in the financial markets. Investors may follow the crowd or mimic the actions of others to avoid the regret of missing out on potential gains or making a different decision from the majority. Decision avoidance. Regret-averse individuals may avoid making decisions altogether, especially when faced with complex or uncertain choices. This avoidance can prevent investors from taking calculated risks or seizing opportunities that could lead to positive outcomes. Housel's exploration of regret aversion in The Psychology of Money highlights the impact of emotional factors on financial decision-making. By understanding and acknowledging this bias, investors can strive to make decisions based on rational analysis, long-term goals, and risk management principles rather than solely avoiding potential regrets.